Hey, this is Sasha. Thanks for joining me in today's video. What I'm going to share with you today is the difference between selling a call and buying a put. So stay tuned. We're going to answer this question in this video. All right, so this question comes from a YouTube comment. I always like for you guys to submit actual comments here on the website. If you want to go ahead and go to the website here, you could go ahead and go to contact us and submit one by voice if you like. That way it's more detailed. You can also check out the Getting Started 101 page here on options. Some freebies there, tons of freebies to download as well. So check that page out if you're new, membership, coaching, products, courses, all that good stuff. But today's question here comes from Paul, and Paul says, options have been hard, seems to confuse things. Yeah, they are difficult. They definitely are difficult. So thank you so much for your kind comments. And could you please explain the difference between selling a call and buying a put and how it affects the Greeks differently since they're essentially the same thing? Well, they're not essentially the same thing. You have two different types of situations, two different types of options. One you're selling and one you're buying. Yes, you make money in the direction if they go in the right or appropriate direction, but they do function differently. So let's take a look at selling a call and buying a put. So I'm going to go ahead and go to the panel. This is the Thinkorswim or TD Ameritrade platform. Let's go ahead and go into, which trade do I not have on here? How about a McDonald's trade? Okay, so if we go into McDonald's and we go in, let's say about 45 days, and we're looking at, let's say, buying a put and selling a call. So I'll go ahead and buy a put right here, a single put, and I will go ahead and sell a call. And I'm going to do this on a different expiration so you can see the difference. Sell a call. Okay, so here's what I got. Okay. So when I look at this kind of trade, and let's bump up a couple contracts. Let's say 3 contracts here, 3 contracts here. So let's isolate it. If I buy a put, money comes out of my wallet. Think of it this way. Money comes out of my wallet and I own and hold a put. That means I have power to that put. But I had to pay for that. Money came out of my wallet and now I own something. Doesn't matter if it's a 170 put, 180 put, I now bought something. You bought a phone, you bought a guitar, you bought fruit, you bought a banana, you own that banana, you can bite that banana. Same thing here. You buy a McDonald's put, you own that put, you have insurance, you can cash in that insurance if things go against you. Or the value of that insurance goes up in terms of the value of that insurance increases if the stock price goes down, because this is insurance on the downside. You also have insurance on the upside, the call side. In this case, we're not talking about that. So here, if you own the put, you have it, you own it, and you can use it if you want. Now, it's just like buying an apple. Do you have to eat the apple because you bought it? No, you don't have to, but you have that opportunity. So here, in this case, you've got the put, but the problem is when you look at this, okay, you've got a delta of negative 76, which means you make money as this thing tanks and goes down. You make $76 for every $1 move. Here, you lose $20 a day to have that insurance because you bought it. Every day you're losing money. The amount that you can resell it for is less because you're using up your time premium. Okay. The VIG I'm not going to touch in this basis because right now I think it's a little beyond the scope of this video. Let's look at selling a call. Well, when you sell a call, you still make money from the direction. So in this case, I make $125 for every move the stock goes down, for every $1 move. So compare that to the put, 176. Well, why is one more than the other? Well, remember, we're doing different time frames for now. If I did it in the same time frame, and not to mention, let's say I go further out, well, you can manipulate that delta. But the point being is you still make money from things going down, just like a put. The problem here is when you sold something. I've sold something here at $1.55. So let's say you had a guitar and you sold that guitar for $155. Well, once it's sold, it's sold. You only made $155. That's the problem in that case. So in buying a put, you have unlimited, almost until zero, downward bias, and that means you can make an unlimited amount of money, again up to zero, as long as that price keeps heading. But the problem, the trade-off to that, is you lose $20 a day for the premium because you bought something, right? Just like an apple decays, a banana decays, a peach decays. With time, it's going to rot. And that's what happens here. With time, this is going to rot. It's going to smell. If you got a fish, it's going to rot. And that's what it is. It's like dead fish. Whereas when you sold something, you're actually waiting for that fish to rot as quick as possible, and you're collecting your premium, your time premium, because eventually it's not going to be worth anything, and you just collect your premium. Somebody bought it, they ate the sandwich, and it's done. So that's what's happening. You sold it. You sold this contract. As long as it goes kind of in your favor or just stands still, you still make your money. The problem here, when you buy a single put, stock stands still, you lose because you lose on the premium. If you bought a put, stock stands still, you lose. Stock goes against you, let's say it moves upside, you lose because you're looking for a downward direction. Stock goes down slowly, you could still lose because you got your time premium problem. You have to make enough to offset that time premium problem. So the only way you win in a downward buying put situation is if you go ahead and you buy things and you buy and it makes the move. If it makes the move and it makes a serious move. When you're selling something, the way that you make money on this, well, if it stands still, you make money. If it goes down, it makes money. If it goes up a bit, you make money. The only way you lose is if it goes up a lot. That's kind of the big difference in these situations, is that this has a higher probability or chance of success, but you make less money if it works out in your favor. Whereas buying a put, well, you have less chance of success, but you could make more money. So it's kind of, which one do you want? You're either a buyer or a seller. It's not that one is better than the other, it's just there's trade-offs. So that's what I want you to understand in this situation, is that these are kind of the trade-offs when it comes to either buying a put or selling a call. Even though they're both to the downward, there are trade-offs to both. So be very careful. I recommend you take a look at spreads. That's why when you go in and take a look at our website, there's Getting Started Options Trading 101, and we've got some great courses for spreads, like we just released the Diagonals course, and many others like Iron Condors, Butterflies, and much more. That's what I would look at once you get started and you're more proficient, you understand what's going on. That's the right approach to making money with options, not buying singles and so forth. Can you do that when you understand the base concept? Absolutely. There's nothing wrong with that. There's a lot of professionals that do this on a single level. But if you're kind of new and you don't get this part of it, then I definitely would avoid doing, kind of individual spreads until you understand what you're doing. All right, so thank you so much for joining me. Feel free to check out some of the freebies over here. Subscribe to the YouTube channel if you're brand new, or just check out some of the other videos on this page. Anyways, thanks again, and remember to do what you love, contribute to other people, but most importantly, live life abundantly. I'll see you next time.